U V W. What will the economy look like once it starts to reopen? Plus, how bad is it really, the process of getting your stimulus check? We've heard mixed reviews on it. We're going to share one that will certainly catch your attention on the program. Welcome to the program. We are, of course, Dollars and Cents. We're Central Florida's longest running radio program. Started well over 30 plus years ago by my late father-in-law, Jack Nelson. Continued today by me, yours truly, Joel Garris of Nelson Financial Planning. What's different on the program, of course, is that now we are more than just a radio program. We happen to be on the various social media networks, whether it's YouTube or Facebook, and certainly on a plethora, if you will, of podcast channels ranging from iTunes to Google Podcasts. To simply find us if you want to listen to the show, or maybe you miss a part of it here on Sunday morning, you simply just look for Nelson Financial Planning, and you'll get connected directly to any one of our social media channels. Make sure you subscribe as well, and then that way you know when we upload new content, because we do that during the course of the week. So welcome again. We're also happen to be one of the top 25 financial planning podcasts, speaking of podcasts, on the World Wide Web, thanks to the folks at FeedSpot. Got that accolade at the beginning of the year. And my goodness, how much things have changed since the beginning of the year, right? Here we are once again. It is Sunday. You're listening to this on Sunday, but we are taping it on Thursday simply because the studio and the rules involving social distancing and things like that cause us to tape it remotely. So the backdrop, if you're watching us on YouTube, is my office, sort of the opposite view of my office. Normally I sit on the other side of the desk. When we tape the show, I actually sit on sort of the client side of the desk, because it doesn't show the messiness of my office is really what it comes down to. So now, before we get sort of to all of the topics that we're going to want to hit on the program today, let's take stock, if you will, of the stock market, right? So we're taping on Thursday, which is the last day of April, and that means that for the month of April, it will soon be in the books, because Friday is, of course, May 1. So at the close of the market on Wednesday, if you're keeping score, the market was down 13%, which is not a big number when you stop and think about it, from its peak of what it hit just prior to all of the impact of COVID-19 in the economy with all the stay-at-home orders. Interestingly, only about 8.5% down since the beginning of the year. So some pretty significant numbers that perhaps suggest that maybe things aren't as dramatic in the stock market. We've talked about that many times over the course of the past few programs. For the month of April, it will actually go down, or at least it's on track. Again, we've got to see how Thursday plays out. For the month of April, you're up 13%, on track for the biggest monthly gain since 1974. Golly, I sure hope you didn't miss it. 1 month ago, all the models were predicting an overwhelmed healthcare system, and that certainly was creating a lot of fear across the investing public and the public in general. And so now, here we go, a shift. There's talk of potential treatments and things like that. And once again, the markets are certainly showing their volatile nature, right? So we saw the markets go down dramatically in response to the notion that the pandemic was going to shut the economy down. And then here it is, it's actually happening. You're seeing all these unemployment numbers come out, and lo and behold, during the month of April, you had like 25 million people apply for unemployment, just a record number. But yet, at the same time, from a market perspective, April itself set a record as well. On the positive side, the best month since 1974. So some pretty dramatic, and once again, underscores the inherent volatility of the market, right? the market is certainly very volatile. It's always an easy decision to jump in or to jump out. The much harder decision is when to get back in, and that's the thing that goes to basic human nature, where you're just not going to be able to make those predictions on a consistent basis. Speaking of basic human nature, if you haven't gotten your stimulus check, chances are you're maybe getting frustrated, and the process, as we've said before on previous radio programs, it's really a bit of a mess. There's been some improvements on the website, the irs.gov website, where you can go to the Get My Payment tab and put in your bank information to try and speed the process along in terms of getting the check. But certainly there's been plenty of mistakes as well, and mistakes that, in our opinion, should not have happened. We mentioned a couple in the past where we had a couple of widows receive stimulus checks for their deceased spouses. But you're not going to believe what showed up in our mail this past week. Far worse than anything that we've described previously on the program. So again, for the folks on YouTube, we're going to use the old video on this. So this is what showed up in the mail. If you're listening on radio, you can see that it says Department of Treasury. It is the Bureau of the Fiscal Service out of Philly, Pennsylvania. On the back, it says, hey, maybe you want to think about direct depositing so we don't have to mail a check to you. So we open up the envelope, and lo and behold, it is in fact a check from the United States Treasury. And we know it is the economic impact payment. And look there underneath that, President Trump didn't get to get his signature on it, but at least he got his name typed on it. So usually the president doesn't sign the U.S. Treasury checks. Someone else takes care of that. But he did get his name printed on it. So this is an actual physical check. Many people won't see this because the vast majority of them are going direct deposit. So the interesting thing, of course, is who is this check made payable to? And we've taken a little piece of Post-it note and blacklined it. I didn't want to do it on the actual check because I didn't want to mess the check up. But it says Jeanette, and then underneath there it says percent, which is, I guess, care of Joel Garris. That's me, and then that's our office address, 423 Country Club Drive. So for this particular individual, we had really the honor. We had known this person for a long time, well over 20 years. We had the honor of being asked to serve as her executor, and we were certainly happy to serve in that capacity. So we did that, okay? And note, I said the word executor, right? So if I am serving as someone executor, that means, in fact, that they are dead. This is not a surviving spouse situation, okay? The tax return we filed with the IRS notified the IRS that she was deceased. Now, hold on, listen to the date. April 28th of 2019. Over a year ago, almost a year ago to the date of the check, 4/24/20. This is just crazy how that could happen. And what's even crazier, look closely at the check, you will see that it actually recognizes that she is in fact deceased on the check, because it says DECD, DECD. That is crazy stuff. No, I'm not going to cash it. I'm going to hold on to it. It makes for a cool presentation piece, especially when you come in the office. So if you come in the office and visit with us, we'll have this check. We can take a look at it and laugh at just how crazy all of this stuff really is. With that, we will shift gears, take a break, and when we come back, we'll start talking some letters of the alphabet. UVW, lots of letters out there and lots of people talking about it, lots of speculation of what the recovery is going to look like. So we'll tackle that on the program next here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning, News Radio, WFLA, Orlando. UVW, what's it all mean? You hear all kinds of talk about those letters in connection with what the recovery is going to look like. And so here on the program Dollars and Cents with me, your host Joel Garris of Nelson Financial Planning, we wanted to take a moment and explain to our listening audience exactly what that all means. You hear people kind of throwing these letters around, and what's it all mean, and what are some of the projections of what the numbers are that are associated with those letters. So if you think of it, if you visualize the letter, right? So a U, okay, is a steep line down, and then sort of a dip that lasts for a little bit of time, and then it goes up the other side. Well, if you think of that in terms of economic terms, you see sort of that front part, right? So that front part, that dramatic drop, if you will, that would be the leading edge of a U, that of course represents all of the shutdowns that occurred and the massive amounts of unemployment that's occurring. That's sort of the front edge of the coronavirus pandemic. And then the U part, the elongated bottom of the U, if you will, suggests that economic activity could stay relatively low for the second and third quarter before recovering, and then the backside of the U is a much sharp increase. And so if you compare the U to what you could potentially happen economically, that would be the kind of scenario where you would say, okay, the economy is behaving like a U. A V shape is obviously very steep, right? It goes down, okay, leading edge, decline, and then a very quick short turnaround, and then economically things go back up. So again, that steep drop certainly took place, right? During the month of April, unemployment numbers going up to 25 million people. The V shape, I think, is generally described as the sort of the best case economic situation coming out of this pandemic, rather than a quarter or two hanging out, in low economic mode like the U would suggest. The V, okay, it really becomes a much shorter period of time, a matter of a few weeks or months before you immediately start to turn around and start seeing that economic recovery again, versus the U, where it might take 4 to 6 weeks. The V shape, it's a 1 or 2 month type of turnaround. Again, V shape, as you might well imagine, is the best case scenario. And then the third one that you hear a lot of talk about is, of course, the W, where you kind of see that decline on the leading edge. You see some kind of an upswing, some kind of a recovery, but then we're struck with more coronavirus cases. The numbers flare up again. You wind up having to have orders reinstituted to stay at home, those kinds of things. And then obviously that's the other part of the W, which is another decline, and then ultimately a turnaround before it then recovers. So that's kind of how the U, where you drop dramatically a couple of quarters or so 6 to 8 months, where you're kind of getting into this recovery part, and then a short, sharp recovery back up. V, best case scenario, okay, you're down, but you're only down for maybe 1 or 2 or 3 months, and then a sharp recovery right back up. And then of course the W, you're down, start to see some kind of a recovery, but then go back down because you have to continue to put stay-at-home orders and things like that in place. So that's the UVW economically of those letters that you hear getting tossed around a lot. So let's kind of put some numbers on those 3 scenarios. And frankly, when you start to put the numbers on the scenarios based upon the economic data, it's pretty staggering. So on the V, which is the best case scenario, you would see economic growth in the second quarter decline by 15% on an annualized basis. And again, we talk about economic numbers, we talk about them on a quarterly basis, but then you annualize them. So it doesn't fully reflect what's going to happen in that year, but it's like if you take the rate for the quarter and then normalize it out to the year. So 15% decline in GDP, that would be hands down the worst on record. But then ultimately, with a V-shaped recovery, the pandemic sort of resolves itself, and it leads to a total cumulative economic output for the year 2020, where the GDP is down maybe 2 or 3%. Again, the media is going to talk about the annualized number at 15%, but it's really only a quarter number that you then extrapolate out to the year. So even if you get a 15% annualized number for the second quarter, for the year, you could certainly have the economy on track to maybe be down only 2 or 3%. Certainly not good by any stretch of the imagination, but that's the V-shaped recovery. The U-shaped recovery, and where we see the reopening happening more on a slow and trickle kind of basis. And it seems like from a government regulatory perspective, that may be more the track of where we are on. We're seeing in some states that have already opened, Georgia being a good example, where people aren't coming out in droves. They're coming out in a trickle, and effectively the stay-at-home orders have a residual effect in that people continue to kind of stay at home and don't go out as much. So that effectively gives you a residual tail, a greater damage, if you will, to the economy in the second quarter, where you could see the economy, again, for the second quarter on an annualized basis being down like 30%, again, well past any record that we've seen. But then in quarter three, it becomes a much sharper recovery. But again, for the year, the economy still looks down probably about 5%. So again, the V-shape, overall economy down 2 or 3% for the year. More the U-shape, you're probably looking at more 5 or 6% for the year. And then of course, the last one, the W, is the one where you have a dramatic decline in the second quarter on the order of, say, 30%. That rolls to quarter three. There's a resurgence of cases of COVID, return to stay-at-home orders, and there you could have some GDP numbers that have a much greater impact. So you could have a GDP of, say, down 7%. So hopefully you see the difference between the V, the U, and the W, why the V is the best case scenario, U better, W worst case scenario. And you see how, if you kind of look at the economic numbers, where, in that V case, you still have a negative growth year for the GDP at 2 or 3%. The U would be more like a 4 or 5%. The W, worst case scenario, economy for the year down 7, 8%. So again, pretty dramatic numbers. You're still looking at an economic output, okay, that for the quarter is going to break all records whatsoever. We just saw the economic number come out this past week for the first quarter, right? And it was a decline of 4.8%. And again, be careful on these numbers because they're the annualized numbers, right? So they take a quarter and they extrapolate it out to a year. So 4.8 is the annualized number for Q1. It's expected that Q2 obviously much worse than that. So what are the driving factors, okay, that are ultimately going to determine whether it's a V, a U, or a W? And I think there are certainly some factors that we want to pay particular attention to as we look at what's happening in the economy and look forward to see what shape that recovery will happen. By the way, in all three of these scenarios, there is in fact a recovery. So let's be very, very clear on that. It's just a function of what precisely it looks like. So we're going to start to put some factors into that, some things for us to look at to determine exactly what shape that recovery is happening. And we'll do that right after this break here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA, or perhaps you're listening to us on one of the many social media networks that we're on out there, whether that's Facebook or our YouTube channel at Nelson Financial Planning, or iTunes, Google Play, or any of that other stuff. If you're looking to find us on your particular social media network of choice, just go to our website, nelsonfinancialplanning.com. And from there, you'll see a bunch of icons in the upper right-hand corner. Click on the one that looks most familiar to you, and you'll get connected over to our channel on that platform. So before the break, we were talking about the shape of the recovery, right? The U, the V, the W. The V, the U, V, W, but in order of preference, it would be V and U and then W. And so we explained kind of what those letters meant that you hear a lot in the media talk about in terms of how the economy might actually respond post the COVID pandemic. And so I think it's important now to talk about sort of what are some of the driving factors that we need to look at to see which one of those will actually be how things play out. Because obviously the reality is that there's a tremendous amount of lingering uncertainty on this. There remains in place social distancing rules. There remains a gradual reopening of different types of businesses, but certainly not all businesses. And even the businesses that are reopening are going to have a limited capacity. So, that's obviously a big part of what the recovery is going to look like. But the other thing, too, that I don't think we can really underestimate, and may in fact be one of the single biggest influencers in terms of what the economic recovery looks like, is a very simple thing that you and I and everybody else controls, and that's the psychology, the thought process that we all have as we look to engage in the world going forward. And that's a huge part of that. That will end up being a major driver of the timing, how long it takes, and the speed or the strength of the recovery. So that psychology really has a big factor in it, and it's important to really get an understanding, and I'm hopeful that the media is starting to kind of shift gears, if you will. I think the media did a good job at freaking everybody out and getting everybody to really follow these stay-at-home orders, which obviously had the benefit of people actually following the stay-at-home orders. But at the end of the day, we have accomplished, to a large extent, what the point of the stay-at-home orders were, right? The point of the stay-at-home orders were to flatten the curve, right? Because we didn't want to overwhelm the healthcare system. The point of the stay-at-home orders were never that we were going to somehow cause COVID-19 to disappear off the face of the planet. Certainly, as you read about this disease, it might very well be something that stays with us for some time, much like the flu or pneumonia or those types of things, where we constantly need to be watchful and wary of how best to try and keep ourselves healthy, and in particular for folks that are older or more susceptible to health issues. It certainly seems, the data seems to strongly suggest now that that group is much more vulnerable. So if you're in that group, you've really got to sort of double down on your prevention exercises in terms of perhaps wearing a mask or washing your hands or those kinds of things. There's no one magic bullet in terms of, if I do this, then I will be fine. It doesn't work that way, okay? The reality is that there are health risks every day that we confront, and this may very well be one of them. And so a lot of that is psychology, okay? So, there is historical precedent for this, and it's not back to 1918 and 1957, and again in 1968, there were flu epidemics that swept across this country that on a proportionate level killed a lot more people so far than what COVID has done. So let's maintain some perspective on it. We didn't shut the economy down in 1957. We didn't shut down in 1968. We did this time around. Hey, that what's happened has happened. But again, the psychology and the perspective of it really is going to be crucial going forward in terms of what the recovery looks like. So businesses are trying to navigate two different fronts. It's become very complicated for businesses because they're trying to keep their employees safe, and they're also trying to keep their customers safe as well. And so what does that look like? What cost is involved in that? What loss of productivity is involved in that? If someone is constantly having to clean, then their time isn't able to be used elsewhere. And so that's a trade-off that every business is going to have to make. And I look just at what we're doing at the office. Obviously, we're doing a lot more cleaning. Everybody has a face mask that we purchased for them, and we're using a lot more Zoom meetings, video meetings, things like that. And so starting perhaps maybe next week, we may have an option for folks to come in to visit with us, but it will be outside, assuming it's not raining, and across a 6-foot table. So there's some things that we're working on for our existing clients to be able to kind of meet with them, because while a phone call is fine, and even a Zoom video call or what have you is fine, it's not the same thing as sitting across the table with a person face to face. So those are the kinds of things that businesses are trying to kind of tackle. Obviously, the lingering unemployment will be a major factor. So now, let's take a moment and try and connect the shape of the recovery or the reboot of the economy to the markets. And here's what's interesting when you start to kind of look at some of the data there is, if you look at historical recessions, and there's certainly been a number over the course of the past 80 odd years, the depth of a recession, meaning how deep a recession was, had very little impact on the decline of the markets. We'll say that again. The depth of a recession had very little impact on the decline of the market. So whether the total economic contraction was 4% or 0.4%, historically, that did not have as much bearing on the severity of the decline in the overall stock market during the course of the recession. What did make a difference, which gets back to the UVW conversation, is the duration. The longer the recession lasted, the greater the hit to the stock market. So if the recession is short, the decline is not as dramatic. If the recession is long, think 2007 through 2009, that was an 18-month recession, the longest over the past 80 years. Obviously, the decline there was incredibly severe, down 55% from peak to trough. So you get the concept of what makes a difference is, in fact, the duration of the decline. The duration of the decline really makes a difference in terms of how it all plays out. So what's it going to look like? Okay, a U, a V, a W. At the end of the day, nobody really knows. I think psychology is going to play a much greater role in that, because that will determine the duration. Remember, it's not the amount of the decline, okay, because we're going to look at some pretty rough numbers in terms of the total economic decline in this situation, but it is in fact the duration. The duration is the key component of it. And so whether it's a U, a V, a W, at the end of the day, it's probably a little bit of all of them. Now, I know, okay, that's a hedged answer, but after all, what do you expect from an ex-lawyer? When we come back, we'll delve more into where we see this going in terms of the economic recovery and the market. So stay tuned for that, and we'll be back after this here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA. This is Joel Garris of Nelson Financial Planning, and we're talking about what the shape of the recovery might look like. You hear all these letters tossed around. Earlier in the program, we described for you what exactly they mean in terms of the economy. A U, a V, a W, and certainly in the earlier parts of the program, we described not just kind of what the UVW looks like in terms of just general economic concepts, but also endeavored to put some numbers on them. And when you start to look at the numbers in terms of economic output, I mean, it certainly for this quarter two that we are in, the numbers are going to be just absolutely beyond any and all records that are out there. And so the question is then, what does the recovery economically then look like? Clearly the market is voting because the month of April was the single strongest month in the stock market since 1974. So that's a pretty strong vote from the market that the VU scenarios appear to be more likely than the more worst case scenario of the W. But certainly some of the big influences that we talked about on the program were perhaps the psychology part of it, and how rapidly people get re-engaged is going to be a big determinant of whether it looks more like a U or more like a V. In our view, you know, it's probably going to be a little bit of all of them, and we don't need to give a hedged answer on that too much. But you know, as we said before the break, what do you expect from an ex-lawyer? The reality is that you know it certainly does potentially have the makings of a V. Certainly that's what the market is looking at in terms of how quickly the recovery has been in the market over the course of the past month. I think some of the early data that we're seeing out of some of the states that have released the stay-at-home orders suggests that it might be more like a U. Those states that have already lifted stay-at-home orders, closest to us, of course, is Georgia. You're not seeing people just rushing out of their homes and going into the stores. It's really much more of a trickle, and that gets back into the influence or the impact that psychology has in all of this in terms of how ultimately the markets will recover, and that's kind of that gradual transition and gradual reopening, which certainly translates to what's going to happen economically. And then of course the W certainly an option as well. I think that one maybe more because the market may have really rallied very, very quickly, very, very strongly, and maybe getting a little bit in front of itself in terms of the recovery. I mean, there's still a lot of tough economic data that's coming out, and certainly corporate earnings are going to take a tremendous hit in the first quarter, and we're currently in the middle of earnings season and seeing some of that. But then 3 months from now, it's the earnings for the second quarter, which I think will just be absolutely awful. And so is the market maybe getting a little bit ahead of itself? So this would start to look a little bit like a W from a market perspective, and that could certainly potentially be the case. You look at how well, in relative terms, the market has fared, and certainly the recovery has been a pretty strong one, at least from a market perspective. And again, remember, market is looking forward, market is looking ahead, and predicting a very strong recovery during the course of the third quarter, which would be generally kind of the months of July and August and September as you get into the fall. And so certainly though, I don't think that we should expect less volatility in this. I think we're going to continue to see a lot of volatility. Obviously, the volatility in March was very negative. The volatility in April was very positive. And I think you could continue to see that pattern play out in the markets as a whole. If I had to pick a letter, okay, hold my feet to the fire and say, pick a letter and what's it going to look like, Joel? I would probably say it would look more like a U. I think the residual effect of the stay-at-home orders are going to continue to play emotionally and psychologically in people's minds. And so as you go through, combined with the fact that most of the reopenings, it's not like it's, hey, okay, we're 100% back opening. All of it is going to be a step-by-step approach, much like Governor DeSantis described this past week. It is a step-by-step, measured type of an approach, which is fine. I think that's a way to prevent the W, okay, of where the recurrence happens. But at the end of the day, I think that leans the economic recovery to look more like a U than a V. Bottom line, of course, is this, right? Don't try and predict the future when it comes to your investments. Your investments, folks, are positioned to do things for you for the rest of your life, not the rest of 2020. Okay, so you've got a long time period in front of you. I don't care whether you're 65 or 75 or even 85, the longevity being what it is, right? The typical 65-year-old married couple, one of you is going to at least see the next 30 years. So that's a long period of time. And we'll get through this, and this will pass, and it'll be history, and we'll all be telling our kids and grandkids about it. And at the end of the day, though, don't turn things upside down from an investment perspective. That's where the real damage can happen. And certainly if you look at flows in the industry, you see a lot of people leaving the market in the month of March, which means what? Which means that they happen to miss the single best month in the market going back over 45 years. Stop and think about that. That's the unpredictability in the market, and that's the unpredictability of how difficult it is to try and make those decisions to get out, to get in. Those are very difficult decisions. The easy decision is getting out of the market because that's when the media is screaming that the world's going to end. A much harder decision is getting back in, because psychologically it'll be hard to get back in if things are in fact worse than where you got out at, right? Because if they're worse, you're going to feel vindicated. You're going to feel proven that, oh, I made a right decision. I'm going to stick with it. Well, guess what? By the time you realize that and say, oh, wait a minute, things are better, things have recovered, then they will have already recovered, and it will be too late to make that transition. So be careful of that. Obviously, more volatility ahead. UVW are the letters you're going to hear a lot about. The backdrop of the actual numbers, though, is going to be nothing short of staggering. When you look at the records that will be set economically and unemployment-wise, it is nothing short of just absolutely staggering. And the percentage of the population that it is affecting, particularly on the employment side, again, nothing short of staggering, that is for sure. So we'll be wrapping it up here on the program. We want to urge people to continue to remain safe, stay well, stay healthy, and make sure that you're following all of the different guidelines that are out there to do just that. Whether it's staying at home or whether it's going out in public, make sure that you are mindful of your fellow humans when you do that. So with that, we will wrap it on up and get on out of here. Thank you all for listening to the program. We'll of course be back next week and have much more to talk about then, as we have been each and every week for the past 35 plus years. So anyway, we'll get on out of here. Thanks for listening. And this has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando.